what, Allison, to you is the biggest takeaway?
So much cleaner, although we still did get a billion here, a billion there, litigation reserves. I think that was part of the disappointment at JPMorgan, better revenue, but you did have a miss on the cost side, and that was a little bit of it. But I think the main positive thing is the better trading revenue, and you hear words like buoyant and strong, but the bottom line is just that it's better and it's stabilizing, and that's better than we've seen in a few quarters.
What do you think?
Yes, I mean, I agree. I think the litigation expense is a bit of noise. I think probably the market is overreacting to this. They're going to, yes, Erik, it's a given that there'll be continuation of litigation expense at these big banks. They can't seem to resolve these issues because they keep doing things that aren't right, that they shouldn't be doing. And so that will be a continuing expense. But if you look at their basic business, which is what theoretically these banks should be trading on, their basic business is getting stronger as the economy improves.
What the market seems to be trading on, at least as far as Citigroup is concerned, is a 5% increase in fixed income trading revenue.
Right.
Since when is 5% something to get excited about? Or
and also,
is
you're
that,
coming from
is
a
that
low base.
Well,
remember what fixed income trading revenue was 3 and 4 years ago.
Is that just the new world we live in?
I think there's two key reasons, right? I mean, it's 5% is great when you've been in free fall for the last couple of quarters, and really, that when you look at the equity strength, something like 16 to 15% up quarter to quarter, and this is normally a seasonally weaker quarter, so people are excited about that. And then if you look across what's been happening in the trading businesses, right? It's volatility. Volatility's been killing these banks. It's been especially horrible in the foreign exchange market. We hit a record low. I think the series goes back to the 90s. It was the lowest level during that time period in July, and we're up 50% since then. And Citigroup is one of the stronger players in that business.
Is the market volatility, should it be making us concerned that Dodd-Frank hasn't been tested yet? Now that we live in a Dodd-Frank world, these banks, these traders can't catch the falling knife and be a backstop. All they can do is act as agent. Is that going to hurt this volatility even more?
One man's agent is another man's principal client service role that they're playing. So, I mean, are you an agent or a principal when you do a trade for a client and you end up having to hold those securities longer than 30 days or 60 days or whatever?
But now they can't. 5 years ago, when the head of fixed income would say...
I think that jury is still out. I'm not sure that they can't. They're going to call that client service, Stephanie, and they're going to be able to hold that, and they're going to be able to show the regulators that they're doing that in service to their clients. I don't think that is a resolved issue yet by any means.
Really?
Well, I guess when I'm...
opinion.
I think the regulatory environment continues to be evolved. I think one of the next steps is going to be what happens with the election. Do we get some changes there? There's a few things with Dodd-Frank that different industry groups have objected to. For example, what the mortgage servicing rights. This has been a major issue that's been impacting the banks. You've had a big
derivatives
chunk.
As well.
Yes, you have these big chunks of banking businesses going to non-banks. That's one of the things that Jamie talked about on the call today. And so with all this regulation, what is actually happening when you're pushing risk out of the system?
Were you on the JPMorgan call?
Yes.
Did it seem like a different Jamie Dimon to you?
Seemed like business as usual.
Really? He felt like a different Jamie Dimon.
I was setting you up right there.
Yes, he did.
There you go, my part.
Because
why did you feel that he was different?
Granted, he's just come off of 8 weeks of cancer treatment, but he sounded, I would say, conciliatory. Well, he was not objecting. Mark Carney and Jamie Dimon have a history, right? There was that fairly famous spat that they had at the IMF meetings in Washington a few years ago, and all of a sudden Jamie Dimon, at least on his conference call with analysts, is kind of agreeing with Mark Carney and what the Financial Stability Board, which he chairs, is doing. And yes, the buy side is demanding some of these things, and there is some consensus in the banking community, and this is a good thing, and we do need to be able to resolve banks, and we do need to be able to have these tighter regulations around derivatives because banks can't be seen to be as risky. That's not the Jamie Dimon that I knew 3 years ago.
But I think Jamie has consistently said that he doesn't necessarily object to regulation and trying to make the system safer, right?
No, of
and
course
especially
not.
With the derivatives trading, I think a lot of the banks will agree that we want less systemic risk, that we do think...
Yeah, hold on, they say that, but when it comes to changing regulation that's going to affect their P&L, that's not what they say.
Right. So you can broadly.
That's not what their lawyers say.
You can broadly say you support regulation and making the system better. But by the way, I don't think this law does it. By the way, I don't think this law does it. I think this law is pushing risk out of the system.
Were you on the JPMorgan call?
I was not on the call, but I would expect that a diagnosis of cancer would change your view about your own mortality quite dramatically and make you think bigger thoughts, more existential thoughts, maybe even be more conciliatory.
Not worth getting in a knockdown, drag-out fight with Mark Carney, I guess.
But
well, at the end of the day, you're going to lose.
At the end of the day, you're going to lose, but when you're in the throes of it, I think it's hard to see that. And maybe...
Well, I mean, I don't know that you're necessarily going to lose. I mean, the $1,000 an hour lawyers continue to plug away on behalf of these banks.
Oh, no, they're chipping away at the regulations,
right.
but you know, let's not forget that JPMorgan settled with the Justice Department and other regulators for $20 billion not so long ago, and there are many people who think that some of that was payback, right, for the aggressive, combative tone that Dimon took with Washington in the years immediately post-crisis.
Well, and there are some people who think it was just extortion, that they have, you know,
maybe
the power.
Maybe they're one and the same.
I mean, if it was just Jamie Dimon's combative attitude, I mean, you know, Bank of America has paid much more than JPMorgan Chase, and we'd have to say that the leadership there has been hardly combative.
I think when
but Bank of America bought Countrywide, and Bank of America bought Merrill Lynch.
Well, and JPMorgan bought Bear.
Yeah, but Bear Stearns alone ain't. Well, and
nothing compares to Countrywide. Clearly, that was probably one of the worst acquisitions ever made. I mean, they paid $4 billion for something that has cost them
50 plus
easily. So that's not a very good decision.
I think just in general, when you think about these legal settlements, right? Whenever there's a bubble, there's fraud. We had a massive bubble. We had a massive bursting of the bubble, biggest losses since the Great Depression, et cetera. When you consider the depth and the breadth of those losses, it shouldn't be surprising that you have legal settlements that are unprecedented. Right.
So and now Bank of America to look forward to the next round of negotiations over the manipulation of LIBOR and foreign exchange and gold. And we heard almost none of that today. We know that some of the litigation reserve at JPMorgan had to do with the foreign exchange investigation. That much they acknowledged. But nothing else.
But again, I think when you think about that, so it is still a headwind. You are still going to see volatility. But again, you think about the depth and breadth of the crisis. You think about Bank of America and acquired subsidiaries, Merrill and Countrywide, the role in that crisis. You think about JPMorgan, their role in that crisis. And then you think about what is going to be the breadth and depth of loss of foreign exchange. Everyone talks about 5.3 trillion trades, 5.3 trillion, but the money that they make and proving the harms, and we have a lot of litigation experts that do a far better job on this than me. They help me understand what's going on. But you have to think about the harms involved and proving the harms involved. And you think about stories about people losing their homes and not paying their mortgage. It's a little bit different than making an argument, well, I lost this many basis points on this fund because you didn't price it correctly. I think
people losing their homes and not paying their mortgage, but those were people who bought homes and signed on to mortgages that they probably couldn't have afforded. This is going to open up a can of worms.
We're not going to do it right now.
Two of them are just going to come at me.
You're not wrong, but I've seen lots of mortgages that people should never have signed with their names down at the bottom that did not have accurate information about their income and their assets, and they signed them anyway. They should never have done that. Now, whether, you know, Elizabeth Warren is right that they were induced to do that by mean-spirited bankers looking to make a big fee, just churning these mortgages left and right.
To say that those homeowners are complete victims here, isn't that hard to? Isn't that a hard argument to make? They did sign on the dotted line.
Yes,
they did buy a home that was far bigger than their income would have suited.
It was a free option for them, and they took it.
I think Allison was just trying to make the point. That
Sorry. I could tell time was running out, and Bill and I hadn't argued yet, and I had to figure out how to get that in.
I would say don't get me started either, but if you look, again, you look at the depth and breadth of the crisis, it's not because of one product or one person or one bank, right? The banks weren't the ones actually making the loans, right? You had mortgage brokers. It wasn't exactly Countrywide. We could argue about this all day, but at the end of the day, the government's going to see loss, and they're going to want someone to be held accountable.
If you actually watch The Bachelor, more Bachelor contestants were mortgage brokers in the last 10 years. I always noticed it. There you go. Eric's favorite show.